My name is Chris Behringer, president of the Behringer Group. For over 45 years, we've been helping some of the best families in America maximize financial objectives while minimizing family conflict. Today, Delaney George is going to interview me about permanent impairment of capital.
What is permanent impairment of capital?
Thank you, Delaney. Permanent impairment of capital refers to a situation where an asset either zeroes out or appreciates in a manner with which it can never be recoverable. It should be on the front of mind of every single investor. It's what I go to bed every single night worried about, and what I wake up every single morning trying to tackle and find ways to defeat.
What causes permanent impairment of capital?
Well, Delaney, history doesn't repeat itself, but it certainly rhymes. And for the last 100 years, it's been the same things over and over and over again that have ruined families and caused economic devastation. Panic, concentration, leverage, bad actors, and lack of liquidity. So panic is easily solved. You have an asset allocation that allows you to stomach the up and downs of the market. You know, we knew a lot of people in 2008 and more recently during the COVID pandemic of 2020 that said, this time it's different. The markets are going way down, and they sold all their securities at a 25% loss. They weren't able to recover that. They locked in the losses. So having an appropriate allocation that allows you to stomach these events is critically important. Everybody needs to know themselves. Leverage over and over again. People over-lever their accounts, and there's no need to it. No need to do that. Getting these extra couple of percentages on a levered basis isn't critical once the wealth has been generated. Positively compounding your assets is what's important. Now, certainly, there's some hedge fund vehicles and some private equity investments where a little bit of leverage is okay, but we would always recommend against putting margin on your stock portfolio. It just doesn't lead to anything positive. Concentration, it's as simple as not putting all of your eggs in a single basket. No matter how good of a company is, it could certainly be replaced with new technology, new innovation. Certainly that happened to Kodak, great company. Then the iPhone came around and was able to take pictures in a much more efficient manner. Got rid of that entire industry. Bad actors, certainly fraud and having people steal from you is not only economically devastating, but it's also emotionally devastating. So every portfolio and investment manager needs to have extremely strong asset controls. And lastly, liquidity. Having too much of your funds in illiquid assets when you need to take distributions to pay for something will lead to sell the liquid assets at lower values, which once again you're locking in losses. So following the principles of Markowitz and modern portfolio theory, having a portion of your assets in cash and fixed income securities should always protect against that, while the rest of the more risky assets are working for you.
What does not cause permanent impairment of capital?
Delaney, that is such a great question. And I found that people often focus on the wrong things as they're designing their investment portfolio and continuing to manage it. One, a bear market does not cause permanent impairment of capital. It causes certainly paper losses and frustrations, but we're always alive to fight another day. Typically it recovers. Markets and economies are going to grow over time, and a bear market should be utilized as an opportunity to rebalance your portfolio and purchase undervalued assets at discounted prices. Presidents do not cause permanent impairment of capital. Whether you're a Republican or a Democrat and you have been frustrated by policies of presidents of the other party, the markets typically are bigger. The markets have proven to be bigger than who is ever sitting in the Oval Office. Certainly, there's a lot to worry about on social issues, but as far as your investment portfolio, nothing to worry about who's sitting in the Oval Office. This one might sound a little bit callous, but geopolitical events and wars do not cause permanent impairment of capital. Certainly, the events that are surrounding those things can be very, very scary and cause substantial volatility. But the markets are able to adapt to that, and they continue to grow and proceed. Certainly, geopolitical events can cause bear markets, but once again, we're always alive to fight another day.
How do you prevent permanent impairment of capital?
Well, Delaney, the playbook was written in 1952 when Harry Markowitz discovered modern portfolio theory. If we stick to those principles, we stick to those concepts, we don't try to be the smartest person in the room, we don't follow every fad, we don't panic during difficult times, the money's going to work for us. The three great innovations of the human race have been the discovery of fire, the creation of the wheel, and the discovery of compound interest. If we can earn our 6 to 8% year over year and watch our money grow, we're able to double it every 7 to 10 years. Certainly if we're taking distributions out of the portfolio, it's not going to double quite as quickly. But all the modeling that we suggest says you have zero risk of ruin at a 3% annual distribution rate. Certainly going up to 4 is appropriate for some portfolios depending upon the asset allocation. But we let the money work for us, we don't interfere, and we make solid investment decisions when markets are down, buying great assets at lower prices. Thank you so very much for watching. This is a topic that I'm very, very passionate about. I think about this every single day. Here at the Behringer Group, for the families that we work with, we are stewards of capital. We aren't investing for 3 months. We aren't investing for 6 months. We're investing for 15 years, for 30 years, for 100 years. And the best way to do that is not to be the smartest person in the room, but to be the most disciplined person in the room and follow the playbook that's already been created. Thank you so much for watching.